Next on C-SPAN, the Senate Banking Committee examines the October stock market decline. Witnesses include John Phelan, the Chairman and Chief Executive Officer of the New York Stock Exchange.
Committee will come to order. This morning we continue our hearings with Mr. John Phelan, the Chairman and Chief Executive Officer of the New York Stock Exchange. As the head of our largest self-regulatory organization, Mr. Phelan, you'll be called upon to take the lead in suggesting improvements and to induce the members of your exchange to adopt them. The specialist system on the New York Stock Exchange has been heavily criticized in the wake of the October 19th situation. The Brady Commission published data showing that at the close of business on October 19th, 10% of the New York Stock Exchange specialists in 50 large capitalization stocks had short positions at the close of business. On October 20th, 36% had short positions. Now, I agree with those who say that no dealer system could have absorbed the shocks we experienced on those 2 days, but the Brady Commission data suggests that some of your specialists who have the obligation to stabilize markets were actually exacerbating the market decline by selling short when the market was falling. I hope that the New York Stock Exchange will take appropriate enforcement actions to restore and maintain a high level of integrity and effective performance among the specialists. You know the business, you know it well, you're well qualified to oversee it, but the self in the term self-regulatory organizations is justifiable as a social structure only if you regulate your markets in an efficient and fair manner to enhance and maintain the trust and confidence of investors. Senator Hines.
Mr. Chairman, I'm glad that John Phelan is going to testify. As you and others have remarked, he sits in a critical seat, sometimes been a hot seat. It could get hotter, but I'm confident that we will get some interesting and good advice from Mr. Phelan today. Clearly, we would like to find out his advice on how the issue of portfolio insurance program trading strategies might be better handled. I'm interested in his reaction, of course, to some of the specifics of the Brady Commission report, not the least of which is a mechanism that would harmonize the setting of margins. I hope that in that discussion we can also talk about what kinds of actions that we might consider or might not consider if they are going to impact the competitiveness of U.S. financial markets from a worldwide standpoint. So I will abbreviate my statement and leave it at that.
Senator Worth.
Thank you, Mr. Chairman. Mr. Phelan, delighted to have you here, and we certainly appreciate the careful stewardship of your years of the New York Stock Exchange. I'm particularly curious this morning to hear you address, if you can at some point, your perspective on what we ought to be doing and how rapidly to begin what I think most people agree should be some kind of a rationalization of our various regulatory mechanisms. If there's some way we can begin a process of at least examining how those ought to be more carefully coordinated, and second, how quickly should we be doing that? Delighted to have you here, Mr. Chairman. Another of your good hearings. Thank you very much.
Thank you, Senator Worth. Senator DeMauro.
Mr. Chairman, I'm pleased to welcome a friend of long standing and a neighbor from not only New York but Long Island to the committee, and publicly thank John Phelan for his performance during the events of Black Monday and Terrible Tuesday. During these turbulent trading days, John Phelan was a symbol of calm and stability, and I'm sure his deportment during the crisis had a positive effect on his colleagues and on the market in general. In short, I hate to think of what it would have been without his steady hands at the controls. Now, in recent weeks and during these hearings, the New York Stock Exchange has been the target of some criticism, some, I think, quite unfounded. In their reports, these critics have pointed out some inadequacies in the New York Stock Exchange's trading system. However, before we too quickly criticize the New York Stock Exchange, we must judge the performance of its members in the proper perspective. Now, despite the unprecedented levels of trading and volatility that the market experienced on October 19th and 20th, the New York Stock Exchange stayed open and the system worked. Oh, it may have come precariously close to the so-called meltdown, but it worked. This is a system, Mr. Chairman, which was designed to trade a maximum of 500 million shares, and I dare say had never traded anywhere near that. Maybe its record had been in the area on one or two occasions of about 250 to 300 million shares. Suddenly deluged with over 600 million shares that changed hands in one day. Now, how could anyone ever have predicted an explosion of trading? Despite this, the system held together. Now, further, in both public and private statements during the last year, it was John Phelan who warned this member and the Securities Subcommittee of the dangers of program trading. So it's not as if he has come totally oblivious or did not attempt to say, we've got to look at this. It presents some possible problems and maybe hazards. Regrettably, those dangers were realized on October 19th and 20th. Now, rather than take the I told you so attitude and walk away from the problem, John Phelan urged the members of the New York Stock Exchange to adopt voluntary curbs on program trading. And the board of the New York Stock Exchange voted yesterday to make those voluntary restraints permanent. And I want to commend you for your action in that area. Now, the decision to impose restrictions on program trading are precisely the type of response to the crash which should make congressional intervention unnecessary or certainly limited. Hopefully, the other self-regulatory organizations will follow the New York Stock Exchange's lead and begin to implement some of the reforms that are necessary and that have been cited as reasons to exacerbate that plunge. Now, I believe it's silly to talk about the need for circuit breakers, such as price limits, when most of the experts agree that much of the market volatility occurred as a result of other areas. And more experts than not have testified that if we put in the so-called circuit breaker as called for, what we might very well do is precipitate in a downward market that we guarantee the market will drop to that level. In many cases, going far beyond what it would ordinarily do if left to the law of supply and demand and the market forces in the free market. If volatility is a problem, then curbs on program trading seem to be a far more appropriate response than price limits. The New York Stock Exchange is again to be commended for its leadership in providing concrete solutions to systematic deficiencies revealed by the market break. Such a curb on market volatility will result in a boost in investor confidence. The exchange's actions demonstrate the proper implementation of the concept of self-regulation. Now it's incumbent upon our regulators and the other exchanges and the other regulatory bodies to undertake, the self-regulatory bodies, to undertake the same kind of actions that the New York Stock Exchange has been undertaking. Thank you, Mr. Chairman.
Thank you, Senator Bond.
Thank you, Mr. Chairman. I join with my colleagues in welcoming Mr. Phelan and later on Mr. Fogel before this committee. We are most interested to hear what you have to say and to learn from your experience as we've learned from others with similar responsibilities in the past several days. Mr. Phelan, I would like to offer you the same encouragement that we offered Mr. Malamed and Mr. Malman yesterday to try to do what you can working cooperatively with the other bodies involved to make the necessary changes in the markets without congressional action. We are willing, I think, if it's absolutely necessary, to move legislation in areas where changes must have congressional approval. But we would hope, to the greatest extent possible, this process could move along with the self-initiated efforts by the New York Stock Exchange and by the other markets. I am fully confident that you have the same dedication and the same commitment to seeing that the market machinery works well. I would only echo one comment made by our colleague from New York that the market came perilously close to meltdown. I'm also very much concerned by what our mutual friend, the former Senator Nick Brady, said, that there still are dangers that significant market disruptions could take place if changes are not made. So I do not believe that we can say that all things are going to be all right, and the only thing we need to do is get away from using computers to execute trades. If we all went back to pad and pencil, or maybe carved orders on stone tablets, it would slow down the market so nothing would happen. We would encourage you to work with your colleagues in Chicago and the other exchanges to see how the markets can be improved. Finger pointing and blaming one another is one thing that Senator Brady warned against. We have to see cooperative efforts among the markets to deal with the problems they all have encouraged. Unfortunately, we in Washington have not set a very good example. One of the great problems you have, as my colleague from Texas mentioned the other day, is that Congress and the administration have not done a particularly good job of responding to the problems in our own economy. We've spent more time blaming each other than working together to settle those problems, and I would encourage you not to follow our example. Do what we say, not what we've done. We look forward to hearing from you, sir.
Chairman Phelan, you have an excellent statement, but it's quite detailed. Would you be able to present it in 10 minutes?
Well, I thought I wouldn't read anything. I would just go over a few points and then open to
questions. Very good. The statement will be printed in full in the record. Go right ahead.
Again, I thank you, Chairman, and the committee for having me here today. I appreciate the comments of Senator D'Amato and Senator Hines and Senator Bond and Senator Worth. I think I would like to start out by merely saying that in all the reports and all the statements, everybody's talked about a single market. And indeed, I think we are heading towards a single market, and in that context, we have to look at it. In some ways, we are single, and in some ways, we are still separated, and not only by linkages and not only by product, but also by customer use as well. You'll notice in this statement that we did a survey having nothing to do with the Brady report of about 300 major institutions representing about $1 trillion. And of those, only about 9% were using derivative products. That's significant in that the universe is narrow, but I think if we'd done that survey 2 years ago, less than 1% would have been using it. So the growth in the use of these products in just a very short period of time is escalating rapidly, and I think it is appropriate that we look at it, if not to be a single market, certainly moving very rapidly in that direction, and we have to face up to that fact. Secondly, as to all the reports, the one that is of particular interest is the SEC report, because they are our direct oversight. And there is nothing in that report that we disagree with. We will work with the SEC. We'll form a working group to see almost immediately if we can't get together to resolve if there are any minor differences in there, and to begin to implement the things that we can do in our own market, and to begin to work on those other things. In that report, I think that we agree with their statement that, on the whole, the specialist system behaved reasonably well during that period of time. There were some problems on the margin. We agree with that statement as well. We've taken action in several cases to reallocate stocks. We probably have a couple of more of those coming up, and we have other disciplinary actions as well. We also think that we need to reinforce the capital of that system, and we're looking in ways to do that. And we also think that reallocation is a good enforcement tool and a good prod and incentive tool, because there's nothing like hitting people in their pocket to do that. And I think we will use that much more aggressively today and in the future than the exchange has used in the past. Well, we have some differences in the Brady report having to do with the staff. Parts of the thing in the staff analysis, we believe that overall the recommendations are well thought out and do make sense, and we agree in general with the concept that they have talked there about regulation. I'm not sure whether you can get a third-party regulation or you need a single person to do that, but in any case, you need to move towards that. An independent authority to study the allocation of credit in the system seems to make sense. Strengthening clearing corporations, I think, certainly does make sense. We talked about circuit breakers before. I think we need to have intermarket cooperation. We've shown we can do that in the equity markets because we have the intermarket trading system and the intermarket surveillance system. and we certainly can do that with futures as well. And of course, I think the sharing of information and understanding a lot more about what goes on in the markets is going to be of greater help to us. In the systems, I won't cover that except to say that it was an enormous task to keep the markets open. We think most of the time the vast majority of our systems process what they were supposed to be doing. We reached capacity in 3 or 4 systems. We think that the problems were on the margin and not endemic to the system. We think if it happened today, we would process 600 million shares with almost no problem at all. We absolutely think by June there would be absolutely no problem with doing that at a peak, and we've got to get on to greater volume and greater capacity, which we can come back and talk to later. I think on the balance, that what we're really trying to do is to balance the traditional purpose of the equity markets, which is really to have listed companies and new companies emerging into the market be able to raise capital in an efficient way so they can invest in plant, equipment, and services and contribute to a higher standard of living in this country and a better quality of life. We also have that other purpose of the market, which is asset management, which traditionally has been done on a valued or a semi-valued basis, and now with other alternatives to that market, also find other ways to shed or try to hedge against risk, and that in doing that have created entire new products and linkages to markets, and out of that have come an enormous speculative urge not only by professionals but by institutions themselves. I think the Brady report said 10 or 12 were the basic sellers on that day. The SEC report said 1 major one. Those kinds of institutions, if in fact the 10 or 12 or the major one would have spread to 50, the problems with volatility, the problems with liquidity, the problems with capacity in the system are almost undefinable at this point in time. There needs to be a balance in the market between the capital raising mechanism and liquidity of the market, the asset management function, and a balance so that you have the speculation that you need to provide some of that liquidity, but that speculation doesn't drive everything else out of the market per se. And lastly, I would certainly endorse what the Brady Commission and what the SEC has said, that we do need cooperation and coordination between the different marketplaces. In our report, we urge that the SEC and the CFTC get together immediately with ourselves, what other equity markets they think are necessary, plus the futures markets, and to sit down to talk about common problems and how we might solve them in some way. And so I thank you again, Mr. Chairman, for having me here this morning.
Thank you very much, Chairman Phelan. That was a remarkable presentation. I expected it to be much longer. It was the shortest presentation we've had, and certainly one of the very, very best. You said in part of your remarks that you felt that the exchange could process a 600 million share a day with no real problems. Let me skip down the various problems that we've encountered in the course of our hearings this week and ask you about each one. Does that mean that they could keep the trade open in all stocks, they'd open on time and stay open throughout the duration in all likelihood?
Well, I'm talking about automated systems problems, but I will talk about delays. Our procedure at the exchange, which has worked extremely well over a period of time, is when you have significant imbalances to hold up the opening to display out through communication systems what those imbalances are, so the specialist doesn't hopefully set the price, but at least there's a reflection of true supply and demand at the market at that time, and we can arrive at a new equilibrium price. So I think we would still proceed with that. We don't like to hold up trading a long time, but on the other hand, we hate to open stock precipitously, and indeed you will notice that in both our actions to reallocate, a lot of that was not only done on price fluctuation, but a precipitous opening of a price within 30 to 35 minutes with such a change in the asset values of those companies.
Did execute all orders?
Yes, I think execute all orders. Execution is not so much a problem on that day, was the turning of the reports. We've done a couple of things. One, we've opened a new blue room, which has given us 20% more trading capacity, and also has allowed to diversify our systems and therefore diversify the order flow. Secondly, we have transferred a significant number of the old odd lot system to the new system, and we think that today, that given the volume we had on those days, we would not have any problems in that at all. Third, we had some problems in the as-of status report at the end of the day, We've made some software changes and added some files so that whatever the volume at 600 million, that shouldn't be a problem anymore. Fourth, we had some traffic delays because of printer problems. We have 30 more printers on the floor today than we had before. But more importantly, we had 215 electronic books on the floor. Today we have 285. All of those orders coming in there bypass the printers as well. So we think we have solved that problem as far as limited orders concerned, as far as market orders concerned. So I think we're a good way down the line to have fixed all the problems we had on.
We had reliable, documented reports that tens of thousands of phone calls were not answered. Is that under control?
Well, that's not a direct exchange problem in getting orders into the exchange and executing it, because orders don't come into us by phone call. It is a problem out there with the member firm community, and I think there are two things. One is that if an RR has 100 accounts and everybody, one of those 100 accounts wants to reach them at the same time, there are going to be problems with that. I think that both the firms and, as I understand, the mutual fund industry as well, are taking steps to improve their communications and help with that. And I just can't tell you whether that's being solved. But I think if you asked that question 6 months or a year from now, it would have been a heck of a lot better than it was on October 19th. But I think that if you're going to get a significant part of the customer base, try to reach the people who are managing their money all at once, you're going to have significant problems in that area for a long time.
Mr. Phelan, one of the sharpest differences between the New York Stock Exchange and the Chicago Mercantile Exchange is margin requirements. You operate under margin requirements imposed, I understand, by the Federal Reserve Board. The Merc margin requirements are determined by the CFTC. The Fed requires investors who buy stocks in your exchange to meet a 50% margin unless they're professionals, and then they understand have a margin of 20 to 25%. The futures market in Chicago, on the other hand, requires margins that are 10%, sometimes even less. As of now, that's been raised to 15%. Now, yesterday we went after Mr. Malamed on this, and he gave a very spirited response. He said, as a matter of fact, their margin requirements are safer than yours. He was very emphatic about that. He said the reason is that they have to make a settlement at the end of each investor has to make a settlement at the end of each day. If, for instance, at the end of the day they've lost their investment, they've put in 10%, the stock has dropped 10%, they've got to come up at the end of that day. Then the next day it goes down 10%, they've got to come up with another 10%. And it seemed like a very forceful position. He wasn't successfully challenged by the committee on it. And you're the pro on it. Is this the case? He said that they're safer because they have to come up at the end of the day. You do not. I don't say you. The investors in the New York Stock Exchange do not. They can go 4 or 5 days, and that therefore, as a matter of fact, from the standpoint of safety, their margin requirements are every bit as strong, maybe stronger than yours.
Well, I think the spirited response comes from, margin is a very complicated subject, and I think the spirited response comes from a misunderstanding of what people on the equity side of the market say about margin. They think that they're talking about their floor dealers, and I don't think that that's a comment at all. As a matter of fact, in dealing with whatever capital requirements they have for their floor dealers, they have an extremely efficient system. A good bit of their regulation is spent on surveilling the economic or the financial viability of their floor traders. The reason for that, if a trader fails, it number one imperils the settlement system, which comes at the end of the day, and number two, all of them are members of the clearing corporation or clear through people who are members of the clearing corporation, and those people have to make up the net difference if it is lost by one person in the system. So they have an extremely efficient system for watching almost on a half-hour and hourly basis the financial viability of those traders, and indeed do in fact walk on the floor sometimes and pull the badges off them and not allow them to trade anymore. I think that's an entirely different thing than people were talking about with margin, which is really basically how much margin does a customer of the system have to pay when he comes into that system and puts up some money. And at least a number of people on the equity side, and the other day we had a meeting of our regional firms, of which there are about 100, and specialty firms are about 200, think that for the purposes of margin, all equity-related securities should be treated like an equity margin. We don't have, and the stock exchange has never said that margin ought to be X or Y. I think that when the committee was kind enough to have me down in November, the only thing that I said then is that it ought to be under one authority, and that doesn't mean they can't delegate to each market some of the authority to allocate that margin, to see what in fact balances they, for customers only, they should be between different projects and different markets. So I think, number one, you have to separate out the dealer system, and the dealer system is different in each marketplace and has its own protections for that, and needs a liquid system in which they can in fact raise money to trade. I think the question comes on the customer side, and certainly I really believe that if you're going to have coordination between exchanges, that other exchanges shouldn't get into the internal affairs of an exchange. We've been very successful.
Get into the what?
Into the internal affairs of an exchange. In other words, I really don't think that I should tell the Chicago Merc how to run the Chicago Merc, all right? When we did the intermarket trading system in equities back in the late 70s and early 80s, the reason why we could get competitors to link into a system and to agree on a certain basic set of rules that each would adopt is we stopped trying to tell each other how to run each other's exchange, okay? No exchange has to be a mirror image of the other, but you just agree on certain basic common rules and apply them throughout the system. We thought it was better to do that on a exchange basis than having some other regulatory authority do that for us. And we've been successful at doing that. And one of the reasons we're successful is we don't tell Pacific Coast how to run their market, and they don't tell us how to run our market. I think what we're saying is, as far as dealers on the Chicago exchanges, is they ought to be able to determine what those margins are and how to protect the system. Somebody independent of both kinds of markets should at least do a study of the margin requirements for equities, for options, and for futures, see how they're related in some way as far as the customer is concerned, and make some suggestions. And that's really all we're saying. And I have no idea at this time whether it's too high, too low, or in between. And I think that's basically what we've been trying to say since this began.
Thank you, sir. Senator Hines.
Mr. Chairman, thank you. Mr. Phelan, I want to commend you for the proposal that the New York Stock Exchange made yesterday to ask the SEC to make your voluntary rule permanent. I want to make sure I understand it. That rule would apply only to the suspension of the DOT system for the execution of program trading for proprietary purposes, or would it be more broad than that?
Now, if in fact the Dow fluctuated more than 50 points from its close, either up or down, what we would do is to take that part of program trading, which is index arbitrage, off the electronic system, both for customers and for proprietary accounts.
So that a large pension fund that had its own computer could not access the direct order transfer system?
After 50 points.
After a 50-point trade? Right. How would you know?
Well, they're usually marked, and I think that we have to pass another rule that says you must put a mnemonic on the order that actually specifies whether that's arbitrage or whether it's portfolio assurance or whether it's basket. See, one of the main things that this rule, well, let me get back up for a minute. It is perceived by a number of people, including the public, that index arbitrage, that which they equate being generic program trading, really is responsible for the volatility. And particularly after January 8th, when the market was off 140 points in one day, and which a good bit of that decline was accounted for by index arbitrage. There was the perception that that was causing the volatility in the marketplace. We then tried to address that because customers, ours, institutions, everybody in the system was beginning to get very agitated about this. So we thought we would put a collar, if you will, on that kind of thing by putting a 75-point fluctuation on it. It was felt that taking it off the system in some way retards it. Now, we picked 75 points because when we looked at the lower figure in 1977, we would have had to shut the system down to those kinds of orders about 72 times. And if we did 75 points, I think it was only 5 times. And if we did it 100 points, it was only a couple of times.
So that I understand, you said at 50 points,
Right.
it would hit about 72 times.
Well, it would have done in 1987. The reason we reduced it was several reasons. Is we're not sure that the fact that it's there doesn't have an inhibiting influence on volatility itself.
My theory on that is that when you set a limit, people reprogram their programs
Right.
to halt before things get out to those limits.
Right, and secondly, don't want to set it too low so that you prohibit the product from functioning as we think it should in the marketplace. And I think getting to Senator Bond's comment, I certainly don't believe that you can go back. You've got to go forward in this world. You're not going to do away with technology, and you're not going to do away with efficient communications. We need to have the market adjust better to it, and we need to do it in an evolutionary rather than a revolutionary way, and that's really what we're trying to do.
Let me ask you about one or two specifics. You mentioned, and I'm glad you did because I was going to bring it up, January 8th, which is an interesting day for two reasons. First, it is the day, the morning of which the Nick Brady report issued. Secondly, it is a day in which the overall change from from open to close of the market was about 141 points. It may have been as much as you say as 180 at one point. And as I understand it, it was not only a question of program trading, but it was largely driven by proprietary firms' index arbitrage. It wasn't done by customers. It was done by, if you will, the insiders. Is that correct?
Basically, there was an enormous amount of professional arbitrage on that. Right.
Why isn't that, in a pejorative sense, insider trading?
Well, that's a very difficult question because I think the reason for that being that it is felt that in general everybody knows where the prices of individual securities are in our market. In general, people know where the price of the index future is trading, and in general, if you want to use technology, you can figure out the spread between the two, and when that spread equals more than a money market fund or something. And in general, if you had the equipment to do it, you could buy one and sell the other.
What you're saying is it became a very profitable insider's game.
Well, it's a professional game. I probably
Professionals.
Yeah,
game.
I would probably use the word professional rather than insider. Right.
Your sense of tact has not abandoned you, even in these circumstances. Was that a major factor in your in the exchange's recommendation yesterday?
Yes, I think that I think that that day really, while there was discussions on about the 19th and 20th, I think two things. One is the Brady report said that in fact, it is one market, and I think the rest of the world, whether they accept that fact or they don't accept the fact, they said, my God, if it's one market, are we going to continue to have these kinds of fluctuations? I think when the 8th of January came, it was kind of the straw that broke the camel's back. I was watching the, not to give a commercial, but to today's show.
Let me just ask you one question, because my time's running rather quickly here. How much effect did the Advest decision and ad and the Shearson E.F. Hutton Super Bowl ads? I saw 2 or 3 of them with my friend Senator Worth as Denver was going down the tube. We wish Denver better luck next time, as long as they don't play the Pittsburgh Steelers, which is highly unlikely. Until we get a quarterback. We would be happy to accept yours any day.
Time's up.
Maybe Green Bay can get in there somehow.
Mr. Chairman, if Senator Hines doesn't like the Pittsburgh Steelers, we'll take them in St. Louis.
My time is going to expire, I can tell. How much of an effect did those decisions and ads have on the members of the New York Stock Exchange being so enlightened yesterday?
I think that what's happened is that those ads reflect an enormous amount of customer pressure, both retail and institutional, on those firms, that their belief that program trading, and I'm sure those customers could give you 100 definitions of what it is, okay, was causing volatility in the markets, and why are those firms participating in that volatility? So those ads led to that, and I think that led to an agreement.
One last question. I understand that you generally feel that the Brady report is on target. Is that right?
Yes.
If you have taken action on your own, making proposals to the SEC, which I assume they will act on, obviously the New York Stock Exchange feels that action, fast action, to maintain belief in our markets, credibility of our markets, is important.
Right.
Do you feel it is equally important for Congress to do its part and, let us say, enact all or most of the Brady reforms as quickly as possible?
Yes, I think that they certainly have viewed the universe in the correct way, and I think that the recommendations make a lot of sense.
And if we stall, if we don't, if we procrastinate, if we don't do anything, or if we appear to be dragging our feet, what's the consequence of that?
Well, markets are very difficult things. I think that you cannot say the consequence in the future was you're not going to have another stock decline, and two, that it may not have the same kind of velocity that it had before. The problem with the stock decline was not so much, and is not New York or a Chicago market or something like that. It really is that major institutions behaved in a manner that was not predicted in the marketplace before, and are attempting by communications and other means to move billions of dollars worth of equities almost instantaneously and demand instantaneous execution and liquidity for those. As long as that expectation is there, and as long as a lesson hasn't been learned from the 19th is there, a lot of what else can be put in the system, okay, still won't prevent that from happening again. But I certainly think the other things that the Brady report talked about and the SEC report talked about over a long period of time are the systemic things that are needed in the system to really address the matters of liquidity and the other things that we've talked about.
Mr. Chairman, I thank you. Thank you, Mr.
Before I
Chairman.
call on Senator Worth, I'd just like to announce that Senator Regal has called and said he wanted to give his apologies. He wanted to be here very much, but he had to attend the funeral of the former Governor Menon Williams of Michigan. Senator Worth.
Thank you very much, Mr. Chairman, and again, Mr. Palin, thank you for being here. I want to thank Senator Heinz for his kind comments earlier as well. I want to pick up on Senator Heinz's other comments related to what I gather is his feeling of a sort of a sense of urgency, or a sense of feeling that we in the Congress have a responsibility to heed the many reports that have come in, and not just to read them and have hearings on them, but to try to figure out a strategy for dealing with what seems to be an inexorable fact, and that has been said by everybody, that these markets, while they may have some different purposes, are intertwined and may be, as you point out, very rapidly becoming a single market. And yet, as the markets are doing this, we have a regulatory structure which in large part assumes that these are totally separate markets, that what goes on in Chicago is completely different from what goes on in New York, and that what goes on in the CFTC is totally separate from what goes on at the SEC. It just seems to me to be a almost ridiculous situation of a regulatory structure that is denying the reality of merging markets. The political problem we face is reflected in the testimony and in the attacks of one group upon another about what we ought to do, reminding me of 6 or 7 years ago when we had maybe the first skirmish in the discussions over the Shad-Johnson Accord. You'll remember that, in which Chairman this Commerce Committee, John Dingell, and I had a very difficult time even getting agreement that the SEC ought to be able to have a voice in advising the CFTC on what they were doing. We had a problem then, and it seems to be exacerbated now. So we have a lot of veto power sitting out there. Everybody's saying, don't meddle in my regulatory structure. And the question is, what do we do about that? We can sit back, as the Congress does in a situation like this too often, and allow all of that veto power to assure that nothing happens, or we can try to design some other kind of a process for moving into this and, you know, increasing the discussion and perhaps getting a broader consensus on the fact that there should be some more coordinated regulatory system. It seems to me that maybe what we ought to be thinking about is a kind of phased approach to this. That maybe we ought to look at a kind of a phase one, in which we ask maybe the Fed and the SEC to come in and look at where the regulatory gaps and overlaps are. That we ought to, in other words, we ought to design some kind of a process of getting all of these disparate groups together to look at this. Have you thought about this at all, Mr. Phelan? I mean, how do we get beyond the veto power political problem we have to arrive at what everybody seems to think is a necessary rationalization, or what Jerry Corrigan has called broader harmonization of these markets? How do we do that?
Well, I think that, first of all, every time you mention the subject, it obviously evokes a great deal of reaction, as you've said. We are regulated in the exchange by both those oversight and regulatory groups, the SEC for the equities and options, and the CFTC for futures. Each has a different purpose, each has a different definition because of the nature of the markets. The CFTC deals with mostly a professional kind of market and has different rules and regulations to deal with that. The SEC really is involved with customer protection and fairness and openness of those markets and everybody that participates in it. I think that what we've called for in this paper, which I think others have called for as well, as a first step is to form a joint committee between the SEC and the CFTC and the participants to sit down and to work this out. The third regulator, which is the Fed, which in normal times you don't really have to have too much to do with, but during times of emergency you better stay close to. I'm sensitive to Chairman Greenspan's statement that they are concerned that if you say the deepest pockets in the world is back there, that everybody will do irresponsible things knowing that they will be bailed out in some way. The Fed in this country takes a different approach to markets than, say, the Bank of England, where the Bank of England not only is involved in everything that goes on in the markets, but was the driving force in the reorganization and the evolution of both the government bond markets and the equity markets in that country. But I do think, and I agree, that it would seem to me to be impossible to say you ought to have one regulator. Right? It's just not.
It's not politically realistic.
You're just not going to get there. So then you got to get on with the next thing, because we have continuing problems, and I think that the problems are just as the same as with exchanges, and just as exchange with participants in the exchanges, such as the listed companies, the member firms, some of whom are enormous users of the futures and equities markets, and others who are not users of it all and hate the product, and as well as the regulatory groups. You need to get them to sit down at the table to begin a dialogue and a discussion to do that. And I think that's how you evolve into something more permanent over a period of time. My major concern in the long term is that self-regulation works 85 to 90% of the time. Right? The reason that you have SEC and CFTCs is that when you really get down to tough economic decisions that really affect the pocketbooks of a whole broad constituent or constituent groups, you do need that oversight authority, or the authority with the big club that's able to make that decision and go ahead. And that's why you do have SECs in this country, and that's why you do have CFTCs, and that's why you have committees like this to do that as well. So I would think the first step is to get the SEC and the CFTC, which I'm sure they're more than willing to do, to sit down, to get the participants together, and to begin to talk and to evolve into something that 5 years out we don't know what would look like, but certainly is better than the process that we're using today.
Well, I pretty much come to that conclusion myself, that I don't think right now we're going to solve this problem legislatively in 1988. We're not going to end up with a design solution to this, and what we ought to be looking at is a process, and it seems to me that we could probably force that process pretty quickly in the Congress to just tell them, do that and get back to us, and that we could do that pretty rapidly, maybe even as part of this whole financial restructuring legislation that we're looking at. One might help to drive the other. In any case, thank you again, Mr. Phelan. Appreciate your being here.
Senator D'Amato.
Well, Mr. Chairman, I want to associate myself with at least the conclusion of my colleague, Senator Worth, because it seems to me that we get up here, and I don't know whether it's the glare of the cameras or the microphone and whatnot, and we all go off on these toots about legislation. And then the witnesses, too, I have to say to you, John, notwithstanding my complimentary remarks, I thought they were rather complimentary about your performance. When I hear you say we agree and there's got to be congressional action, which is basically what a lot of people, at least my colleagues, have been saying, that the Brady report calls for, I don't really see it that way. I think there has to be, as Senator Worth has indicated, the move by the self-regulators, by the market, and if necessary, the pressure has to come from the Securities Exchange Commission and for the CFTC to bring about the kind of coordination that people are talking about. But for the life of me, I'd say, what specific congressional action, now I'm talking congressional action, should be taken? Would you recommend any?
I don't think we're in disagreement, Senator. I think that, for instance, I can think of no congressional action that would have prevented the week of the 19th, all right? I mean, the universe had changed, the environment had changed, the use of the marketplace had changed, and no law, no regulation would have changed that. The only thing that I think that we have to address, which is really what I think the Brady report addresses, okay, is at some point in time, if you can't get one regulation, you need coordinated regulation to do that. And if it can't be done on an evolutionary basis by the self-regulatory organizations and the regulators themselves to do it, then Congress may have to come back and address it. But
well, 30 or 60 days from now, if you see that there was not the kind of activity and motion and coordination that you think there should be, you might be prepared to recommend specifically that Congress order and as Senator Worth has indicated, the regulators to undertake a specific line of communications or to bring about the kind of coordinated activity that's necessary.
I think they will, and I think they're already doing it. I think there's great willingness on the part of the SEC and the CFTC.
I mean, I just have to indicate to you, I'm not afraid of legislative initiatives, but I am concerned when I haven't seen anything specific and I hear my colleagues saying, yes, we need congressional action. My God, I think we're the worst ones to come in at this point, given the intricacies of this marketplace, etc., the volatility that one could stir up by some kind of legislative action that might read well, but not do well by the marketplace. Let me ask you one other thing. The Brady report called for the Federal Reserve to maybe act as the super regulator, so to speak. Would you support that?
Well, after Chairman Greenspan said he didn't, I have a hard time doing that, I suppose.
Left you a good way out. Thank Greenspan for that.
I think, Senator, the answer to that is that in normal periods of time, you really need the Federal Reserve involved when you have a liquidity crisis such as we had on the 19th, all right? I think the thoughtful way to do is to how do you get into that, because they are the ultimate allocator of credit, and how do you plug them into the system so that you don't have a situation where everybody says, don't worry about it, they'll bail us out, okay? Yet at the same time...
That's something that should be more formalized, a method, a procedure put forth.
Yeah.
Let me ask you one other thing. Do you think that the criticisms in the GAO preliminary report about the exchange's system's performance during October 19th and 20th were fair? And if not, why not?
I think that I would have said in that, the only thing I would have changed in that report was that on the whole, okay, in 85 to 90% of the time the systems were operating as they should. The 10 to 15% of the times they were talking about or what they reported in there, those are the things that we have shared with them and showed them where we had the problems, where we had the system delays, and those in a more general way that I shared with this committee back in November. So certainly we were not perfect on the 19th, but we did get most of the orders through the system most of the time. And as I say, to show that the system didn't have a systemic fault to it, we would not have been able to, in such a short period of time, to bring on the improvements we have. So today we think that if we had the 19th tomorrow, we would have had very little problems within the system.
Yeah, John, everyone supports and talks about, every report, greater coordination among the affected parties, both the federal regulators and the SROs. Everyone talks about this. What have you and the exchange done to coordinate the regulatory initiatives with the derivative product exchanges since the October market?
I think two things. One, we've tried to analyze what we have to do after the 19th and get our own house in order and work on that. And I think we've tried to detail in that report. In recent times, Mr. Malamed...
What about what... Okay, that's what I want.
In recent time, Mr. Malamed and I have had several conversations. One one for probably 2 or 3 hours, about what, if anything, on the circuit breaker side that we might do to coordinate. I think that we are still continuing those discussions. One of the things that I'm coming to the conclusion is that the futures markets probably needs and can tolerate a little bit more volatility than our markets can, and so perhaps the types of things that we might agree or coordinate to would not be identical. But if in fact we use 50 points on the Dow, they might use 100 or 125 or something like that. Secondly, I think it is important that whatever we do, we at least let them know that we are going to do it ahead of time. They know what the rules are and vice versa, so that when it takes place, they have been able to have time to figure the impact on both markets and to do those as well. Third, I think that a great deal of progress can be made in the sharing of information and the participants in the market and the potential risk that's in the market there and the growth of different products. And I think that's an easier thing to do. It's essential for everybody to do in their planning process and to do the other things as well. And in fourth, in a regulatory point of view, which is really non-competitive, and where we've been very successful with the equities exchanges, to bring them into the ISG group in some form or other, the intermarket regulatory group, and to begin to share regulatory information, to perhaps to build models that shows not only who's doing what in the equity market, but the futures markets as well. So there are a number of things underway, and I think those will accelerate now.
Very good. Mr. Chairman, I want to commend you. My time is up for calling these hearings and having the perspicacity to see them through, and for the excellence of our witnesses, and particularly John Phelan. And I'm pleased to commend again John for the activities that he's undertaken already and implemented, and those that he continues to pursue.
Thank you, Senator Morrow. Senator Bond.
Thank you, Mr. Chairman. Mr. Phelan, I was particularly interested in that last answer of yours, because I think that goes a long way to answering the questions that we on this committee have. I would only add as a footnote to Senator D'Amato's comments, the one area we couldn't expect the exchanges to take any steps is if we have to decide who the first among equals in coordinating regulatory policy might be. As our chairman has mentioned yesterday, I think that that is something we have to look at. But going back to your regulatory efforts, sir, I know that you did in your prepared statements indicate that there were certain instances where you did take action against specialists and reasons for it, but you did say the specialist system performed better than any other system across the country or around the world. And I was just looking back in the Brady report on page 49, where he said fully 30% of specialists in a sample of 50 large capitalization stocks were net sellers of those stocks on October 19th. Further, 10% of the specialists in that sample finished the day with net short positions in those stocks. And on page 50, he indicates that from the final hours of trading on October 19th through October 20th, a substantial number of New York Stock Exchange specialists appear not to have been a significant force in counterbalancing market trends. I wonder if you would discuss with us some of the steps that you're taking for the future with respect to the specialist system.
Well, I do two things. One, I certainly still stand by that. I mean, and the reason I think that the specialists did better than other dealers is that they have an assigned responsibility. And we can argue about how well they carried out that assigned responsibility, but I think that assigned responsibility did have them do better than other markets, and certainly the over-the-counter markets and so forth. Secondly, my really only one bone of contention with the Brady report is in the staff report, and I have the greatest respect in the world for Dr. Glauber. Indeed, I send some of my people up there to be educated by him and different groups. One of the things that he does teach our people when you go there in the human resource aspects of it and management aspects is that you define accurately what each function is, and you define what each participant's responsibility in that function is, and you measure them against that. And indeed, in the best traditions of the Harvard Business School, we have defined what the specialist function is. We have it written down. We have a job description. And that job description has been agreed to by them, by the board of the stock exchange, and by the Securities and Exchange Commission. We also have empirical measures of how that is carried out. Right? And so my only bone of contention is that they dismiss those and would like to apply another standard that is not in the system now. I would have no problem with if they had said that given the job description and given the approved methods of measuring, okay, the specialist did X, and I think they did a reasonable job under those measurements, and I think the Securities and Exchange Commission came to the same conclusion, all right? However, they might suggest in the future that we look at Y, which is whether you can be a net seller in a down market, and there is a basic fundamental of dealers all over the world in that if you inhibit them reliquefying, you in matter of fact wake up and not have any dealer system at all, okay? You need that system there when the deluge is finished in order to continue on the markets for the next few days. Secondly, there is no prohibition against short selling both in any market by any dealer, provided they don't reach across the market and continually drive the stock down, which is why we have tick test number 1, and we don't allow any liquidation on a minus tick, which means they can reach across the market and drive the stock down. And we don't allow short selling except for on plus or zero plus tick, so again they can't reach across the market and sell it down. So I think that other kinds of measurements and dealer responsibility is an appropriate thing to talk about in the future, and indeed we will be sitting down with the Commission and talking about them because they talk about some of those things as well. But to say they did not do an adequate job on that day because of those measurements, I would remind those people again who train our people that you have to define what the responsibility is and you have to measure them against that definition. And clearly in that day, there was no definition that prevented that. And also, I do not think, considering 600 million shares and the amount of volume that the specialists did, that they hardly affected the trend at all.
There's been discussion in a recent article in the Wall Street Journal talking about building up a reserve or an insurance fund for specialists. They've talked about various ways. Excuse me, my time is up. I'm going to set a precedent and stop. If you care to comment on that, I'd be glad to hear it.
Yes, we are looking into that. And the insurance industry, I think, has something like that. One of the things is that we think that probably line of credits are better than that, and two, the ones who probably, for whatever reason, the better ones probably will come in last when there is no money, all right, and the first to go will be the more weakly capitalized. So we think we ought to look at that, but first we need to strengthen each unit's capability to take positions in extreme periods of time, and secondly, to expand the lines of credit, and then probably thirdly, then we ought to look to some other kind of pool of money to do that.
Thank you.
Senator Chafee.
Thank you, Mr. Chairman. First, I'd like to join in the commendations for Chairman Phelan, what he did during this difficult time. Mr. Chairman, I'd like to ask you a couple of questions, if I might, referring to page 17. I'm not clear where you stand on this one regulator business. You indicate that until we have one regulator in place, you recommend that they form this joint committee and work together. And then until we arrive at one regulator, such joint committee would be an effective interim step. I gathered in your answer to Senator D'Amato that you really aren't sure that we'll ever need to get to that further step. In other words, the effective interim step of the joint committee might solve the problem. Is that your position?
Well, if I could play God, and you say you could have...
Go ahead, everybody else does around here.
And you could say have any one thing, all right? I'd like, at the end where the hard questions come, I'd like one single authority who could say yea or nay.
But...
Right? And however, I'm a realist enough to say, listen, you can't hold up all these other things waiting for that to happen. So I think all these other things have got to get underway right away.
You mean these other tries, the interim steps, as far as the
sure.
The clearing, unified clearing systems, coordinate. Now, on the clearing systems, Brady report spent a lot of time on that. You think that can be worked out by cooperative, some unified system of cooperation?
We don't have a clearing corporation, so I can be perfectly objective about all this. Clearing corporations, both in options and futures and in equities, are run differently. I think that the important thing is that they begin sharing what the risk exposure is under the market under certain conditions, and perhaps play what if about in extreme conditions what could happen and what they would do about it. We have, for instance, in the equity side, had a long debate about whether we could go to a certificate-less kind of a depository and clearing corporation. There's a lot of people that do a lot of work in the clearing corporations. There are banks, there are securities firms, there are futures firms, there are options firms, and so forth. There's a lot of financial interest involved in all those clearing corporations. It will not be an easy process if, in fact, you want to merge them all together. But I think it would be a much easier process in sharing information and sharing risk factors and coming to some disaster scenario. And so I think you ought to start with the easier ones and then go down that continuum over a period of time. And the sharing of risk information, I think, can be done, and I think will be done by those parties.
Well, in his testimony, Senator Brady spent quite a bit of time on that.
Right.
Let me ask
because if the clearing corporation blows, you've got significant exposure to the entire system and to the banking system as well, and then back into the Fed, and so that's why they spend so much time on it.
One of the things that worries us, at least worries me, and I must say I have a general tilt toward the Brady Commission recommendations, but one of the things that worries me is, and others here, is our competitive position vis-a-vis the foreign markets going to be affected if we have further regulation, increased margin requirements, and so forth? What do you think about that?
I think that margin requirements really are to add some prudence to the system. It seems to me that for instance, there's a theorem of fire insurance that if you make the insurance premium on $1 million worth of fire insurance too low, you'll sit there and watch the whole town burn around you. All right, and I think that that's the same thing with margin. Margin is to allow a reasonable amount of participants not to have the entire expense of operating within the system, much the same as consumer credit operates. But at the same time, that if you allow too much of it, you create too much volatility, you create a tendency and a temptation to over-speculate in that market. And so what you're trying to do is arrive at a balance, right? And I would certainly not say that derivative products should have the same margin requirement as equities. I don't think that's...
No, he wasn't suggesting that. No. But do you think, as you looked at the Brady Commission report, do you see items in there that would, in your judgment, harm our competitive position, the U.S. markets versus...
Do I see it? No.
Yes.
No. I mean, after all, let's take a look at they talked about some way to regulate the intermarket system, and that's not going to... And I think that regulation would be a minimum, as it is in the ITS system, for instance, all right? Secondly, they talked about some balanced form of credit allocation, and I think that done prudently, that wouldn't harm it. Third, the strengthening of the clearing corporations is certainly going to aid, not harm that in some way. Circuit breakers, which is really the first and the fourth put into one, okay, you know, providing they're not onerous and providing they don't take place every day and providing they don't...
Well, you suggested a form of circuit breaker yourself, haven't you, in this?
Yes, right, and I think each market has got to have some, and there are probably one or two that have to do with the cross-market relations as well. And certainly the fifth, which is information gathering, I think none of those would harm our competitive position.
He had the margin requirement in there, though.
The margin requirement provided it was handled sensibly. I mean, if you make the market so onerous that in fact you do away with options and futures, then you are going to handle it.
Okay, fine. Thank you very much.
Right.
Thank you, Mr. Chairman.
Senator Graham.
Mr. Phelan, one of the issues that I have been interested in during these hearings has been the extent of economic sovereignty which remains with the United States in the context of the internationalization of so many of our economic decisions. In the area of securities markets, what do you think would be the perimeters of regulation domestically before we started to get over the line into activities that would significantly and adversely affect our international competitiveness?
I don't think that we've discussed anything this morning that in fact would affect our international competitiveness. I think that if in fact you tried to eliminate or severely deter a product, whether it be equities, options, or futures in this country, that certainly in equities you could easily drive a good bit of the institutional trading right to London. If you did options and futures, there's no reason why you couldn't step across the border to Toronto and build almost domestically a very large futures exchange or options exchange in which that building would have to flow north. Therefore, if you wanted to inhibit that, you'd have to put something on your institutional and pension funds that prohibited them from going offshore to do that. And certainly don't think that you would want to do that as well, because you want them to allow as many investment opportunities as you can. So I think that anything that would restrict the development of innovation, whether it be technology, communications, or product development, and the use of that innovation in the market, and would almost eliminate it when you have a whole user group who find it useful, then you run the risk of pushing that offshore. On the other hand, if you allow no coordination, and if you allow absolutely no regulation at all, then you are going to face some of the problems down the road that we faced historically, which is why we put some of the regulation in. But I'm a big believer in that you need certain minimal structural regulation, but that over a period of time you get a lot of regulatory underbrush that grows up, and you got to clear that out every once in a while. In the last 5 to 7 years, we've cleared some of that out, but you got to be careful that you don't clear out the structural underbrush, and I think that's where we're focusing on. On the week of the 19th, we had a whole other set of things come into play that we probably didn't realize was in the system, in that institutions would begin to act differently than they have in the past, who have significant amounts of money, and will begin to demand, or at least try to demand, almost instant liquidity for billions of dollars worth of transactions, and those transactions that come enormously swiftly, not in the traditional manner, but in the manner that, in fact, we've helped to build over the last few years, through electronic systems, and that the whole shift of liquidity and the whole shift of risk allocation and the whole shift in how you used to handle those institutional demands suddenly were focused in that week as the 19th. And yes, I think that after that, I think the Wall Street Journal had an editorial yesterday which says that a lot of lessons were probably learned in risk-taking, that there was a great deal of forgetting about that there was risk in the market, that you could hedge everything, that really you were in a no-risk world, and clearly everybody has come back to that realization. But still, we have not focused on perhaps the shifting needs of major institutions, somewhat of what their responsibility is to that marketplace, but also how the marketplace is going to adapt to handle some of that new risk and the shift of risk from one market to another that's there. So I think those are the things we need to concentrate on, and I don't think those will in one way or another affect our competitiveness overseas.
One of the specific recommendations of the Brady Commission, which has raised the specter of adversely affecting our international competitiveness, has been the circuit breaker or other approaches which would set some limit on swings in the market on a daily basis. If you've already commented on this, I apologize for my late arrival. If not, I'd be interested in your comments as to whether that tactic would have the effect, in your judgment, of driving business to London or other offshore locations.
Well, if the circuit breaker is so onerous and in effect creates illiquidity in one or more products, or creates the normal function of one or more products, then yes, you have to worry about that. I think that one of the things, we had a very interesting meeting Wednesday. We brought in 25 of our major firms. Most of the business was represented at that table. Both the very large firms who are obviously operate in these intermarkets that we talk about, plus have big retail and institutional things. Regional and specialty firms would deal basically with retail and some institutions as well. And there's a great diversity of opinion about these markets. If you took a vote today, the vast majority of our member firms would say they don't like these kinds of products, all right? But the firms that contain a lot of business are torn apart internally because of their retail and institutional business and their trading business on the other side. What we said to them was that what we wanted to discuss is how we can see if we can get a handle on some of the volatility in the market because of public perception and their own people's perception as well, But they have to understand one thing, that what we are saying is that this is a new world, that we think the markets are going to change, that they should change, if possible, on an evolutionary rather than a revolutionary basis. That's what we're trying to do, is to control and pace that change, but that the change is here to stay, that you are not going to do away with equities or options or futures, and that to try to do so is futile, that you are not going to do with technology and communications, and what you have to do is to learn how to use it better, and perhaps sometimes you have to put a little governor on it, just the same as you don't allow all automobiles to go at 155 miles an hour, but that the system has got to learn to use that. And we had almost unanimously at that meeting, they asked us to take all program trading off our systems, period. And we said that as an exchange, we had a great deal of difficulty with that, because we have never separated one class of users from another. That we built a highway for all users, whether originally it was manually or now it's electronically. That, in fact, you should only put the governor on when in some way, for some period of time, it seems to be endangering the system. Right? And that we are trying to arrive at a balance between the capital-raising functions of our markets, the asset management functions of our markets, and the speculation that's needed in those to service the other two, making sure that speculation doesn't overwhelm the market and drive everything else away. So what we're trying to do is arrive at that balance, and it's an imperfect procedure. These circuit breakers they talk about only talk about intermarket. They don't talk about the baskets that come over the top from the pension funds, for instance, who just keep pumping at I think the average basket's 25 million, you know, almost by second, 25 million, 25 million, 25 million, 25 million. We haven't figured out how to slow down that access into the highway so the liquidity is there to handle it and you haven't over-the-powered the market in. But I think we're trying to experiment it. It is a new world. We're trying to deal with that new world. And we're trying to do it in a way, and we share your concern, that you don't drive those markets offshore. Because, after all, we have a vested interest in doing that. Our state, New York State, is a great financial center and has a vested interest in that. And our country has a great vested interest in that. And so that it's in all our interest to keep the business here and encourage new business to come in. So what we're trying to do in a very inexact way is to try to feel our way along this, not to let everything tear, because we're going to lose a lot of the traditional participants that are in our market. There's all kinds of talk about shifting back into bonds by institutions and other things. To keep those traditional participants there, bring in the new technology and new products, and allow it to be integrated so that if you're an individual or you're an institution and you find a variety of ways in order to hedge your risks or take new risks or make a value judgment on the marketplace, you can do that and you won't be shut out by everybody else, but everybody lives in that one new united marketplace. And I think that, you know, we're certainly not perfect at doing it, but that's what we're trying to do. But boy, we're sure not trying to shut down or eliminate any one segment of that marketplace.
Thank you, Mr. Chairman.
Chairman Phelan, I want to follow up on what Senator Wirth and Senator D'Amato were pushing for, and I want to see if I can get a clear and definitive answer here. You indicated that if you were God, you would perhaps favor a single regulator who would have the authority to act, but you think it's unrealistic. Of course, that action is a decision for us to make as members of Congress, and to use our judgment on it. In his appearance before this committee 2 days ago, Chairman Reuter of the Federal Reserve Board of the SEC made the following statement. He said, "The Commission believes that attempted coordination of regulation with respect to equity-related products may produce irreconcilable disagreements, and that measures to resolve disagreements between the Commission and the CFTC must be created by new legislation." And he felt that Congress had to reconcile the fact that those differences would come up. And I'm not clear as to what your position is on that recommendation by the SEC.
What I'm saying is that in my management training, that you have to have one voice finally when all the disputes and says yay or nay. All right? We don't have that in the system right now. If I had one silver bullet, okay, that's the one I would use. All right? I think having done that, you can get everybody to work together, which you need to do. You cannot, individual exchanges and markets just can't depend on the regulators to do all their job for them. They got to do most of the job because they're the participants, they're the closest to the market, they understand what's going on. But every once in a while there comes an issue so difficult, so hard, right, that you need a third party to say, this is the way it's going to be.
That seems so clear and logical that I can't for the life of me understand why members of the committee and members of the Congress won't go along with that. We created the Congress, not we, years ago. The Congress created the SEC. It's been a tremendous success. It's greatly strengthened our markets. It's provided for greater integrity and security. Now they say they need this additional power. After all, we're dealing with equity markets here. It's true the CFTC has the jurisdiction. We know how that grew up more or less by accident. For us to act to give the SEC that integrated power over equities makes sense. I don't see why it should be hard. And having listened to the opinions of Chairman Dingell in the House and Chairman Markey, both of whom are going to have a great deal of influence in this area, it seems to me that it's not unrealistic to expect that we could get that kind of action.
I just want to make sure that my comment is not interpreted as an anti-CFTC comment. I mean, we have them as a regulator in one of our business, and they do a perfectly fine job in that, so I'm not talking about that. I'm talking about final authority to make that decision.
Then he goes on to specify where those disagreements may occur. Regulatory authority for equity-related products with respect to critical intermarket decisions such as coordinated trading halts and anti-manipulative and front-running rules and other matters. Have any trouble with that? Giving the SEC authority with that respect, exclusive authority?
Yeah, I'm used to that regulation, so for me it's not foreign.
Then he says finally the Commission's present authority to review proposed index futures contracts to ensure that they are not susceptible to manipulative activity would be expanded to include review of both the new and existing contracts and to permit consideration of the impact of these products on the orderly operation of the stock market. Any problem with that?
No. As a matter of fact, you will notice in our written testimony, we also think that we're going to require the member firms to at least give us a yearly impact study on the products that they have and whether they've changed enough and what that does to their operational and financial performance and what they think that does to the exchange performance, because we need to know how fast these products are changing and how many new people are entering into it. And as I used that comment before about our study of the institutions, the fact that only 9% of the 300 that we surveyed use them may be significant in itself, but more significant is if we'd done the survey 2 years before, practically none of them would have used it. So that's an enormous change, and that 9% or 10% or 20% as it continues to grow can have an incredible effect on the risk allocation, not only in the futures markets, but in the equities markets as well, and also the systemic automated operations that we need both in our member firms and in our marketplace. And so you need to have that, and you need to coordinate it in some way.
Now, you commented briefly on the Don-Tick rule.
Yeah.
And it's been alleged by very capable people that the Don-Tick rule has been modified by the SEC so that it's ineffective, so that you have a situation where Bear Stearns or Merrill Lynch are not allowed to sell on the Don-Tick overall, but if they're working for an investor who wants to sell and sell big and have some effect on the price of stocks, that particular investor is able to sell on the Don-Tick rule without violating their present interpretation of the Don-Tick rule. A modification that was made that it's alleged had a considerable amount to do with the fact that there was a 500-point drop.
Well, I think, first of all, I think the no action letter by the SEC to Merrill Lynch, as we had interpreted it, was extremely narrow. And I think you need to get the SEC to interpret that again. What we are concerned about is there are enormous rumors in the marketplace by any number of people that, in fact, the short-selling rule is being ignored or there has been some other way around it. We have had our examiners out. The SEC has had their examiners out. We find no evidence of that. But what disturbs me about this is much like the insider trading before the Boesky incident, in which we looked and other people looked at movements in stocks before the news was announced, and somewhere in your gut, although you couldn't find it, you said, you know, somewhere there has to be leakage. There is that same kind of comment about the short-selling rule today in equities, and we're very concerned about that. As to what effect that might have had on the 500-point drop, I don't know. But according to both the Brady report and the SEC report, most of the selling that they attributed to the heavy pressure on those 2 days was long selling and not short selling.
Well, I commend you an article by Martin Mayer that appeared in Barron's recently.
Yes, I know that. And
are you familiar with that article?
Well, it disturbs me. We're out there looking for that evidence, but I'm very disturbed about that. But not only that article, but in the last 2 weeks, I've had any number of people in from the industry, none, however, though, who are practitioners in this area, who say that they are absolutely convinced there is a violation somewhere. And as I say, we've had long talks with the SEC on it. They have examiners out. We have examiners out. And there may be some other... We do know you can go overseas. You can go to London and do it. And that we do know. Some of it takes place. London doesn't report volume and trade transactions, so it's very difficult to find out. But we don't think at this point in time it's significant. But as I say, we're kind of flying blind on information. But short selling and the violation of short selling bothers us very much.
Thank you, sir. Senator Worth?
I have one further question. Some years ago, you were involved in an effort with a number of us to attempt to look at the one share, one vote issue. And that's a little bit distant from where we are today, but I suspect it's going to come up again here in the next month or 6 weeks. What is your position, New York Stock Exchange position, on one share, one vote? And how do you answer those who say, I have a company that is structured in a different way and a one share, one vote standard is not fair to me to structure my company in the way that is unique to my particular goals and governing process?
At our board meeting yesterday, a public director said, well, after a big discussion about all this business, said, well, at least one thing it's done is got us off one share, one vote. And I said, not really.
Well, I'm glad I
periodically,
bring you back on it.
Well, periodically we have a round table which we invite about 18 chief executive officers of our listed companies to come and see a demonstration on the floor after the close, 6 or 6:30, and then we have them up for dinner and we have a 2-hour discussion and get them up before 9 o'clock. The last one we had was 2 weeks ago, and that's all they wanted to talk about. And so it has not gone away. And the main thrust from our listed companies is that it ought to be changed, and that in fact, we have said and testified here that if you would ask me, I still like one share, one vote. But it seems to me in a changing world, as long as you can get an alternate method in which we have proposed, in which you go to your shareholders, and if the majority of the shareholders and the majority of the independent directors say that it's all right to recapitalize, then you should be allowed to do so. We have about 59 companies who have done that, and we have that on hold from delisting while the SEC determines what's happened there. We have 14 companies that no matter what kind of change you make would not have qualified because they didn't ask anyone and they went ahead and did it. So I think that our proposal is somewhere between just getting rid of the whole thing altogether, all right, and keeping the old standard but trying in some way to adjust that standard to the modern world that we live in.
Thank you very much, Mr. Phelan.
Senator Graham?
Mr. Phelan, I was recently in London and talked with some of the people involved in their securities markets, and one thing that interested me is the difference in approach they take to the specialist for an individual stock. They, as I understand it, use a tiered system, and for those largest corporations listed on the London Stock Exchange, there are multiple specialists and then fewer numbers as the trading in that stock declines. Has the New York Stock Exchange evaluated the effect of the one specialist, one stock process and its effect on the events of October 19th, and B, with that evaluation or independent of it, if you considered a multiple approach analogous to the London exchange?
Actually, the events of the week of the 19th would tell you that you didn't want multiple. You wouldn't want to have been dealing in that market on the 19th, and indeed the over-the-counter market here had significant problems. That pointed up two things. I think one, if we deal with here and in London, the deepest pockets in the world were in those markets. Indeed, in the over-the-counter market here, and for many of on the London Stock Exchange, which is really an over-the-counter market, you had many of our member firms and banks making markets in there. It shows two things: that one, in an avalanche of selling, money alone is not the criteria, and that given their druthers, most traders around the world are going to step away until a new base looks like it's being established before they come back in. And I think there is a good rationale for that, because if everybody loses their money, then you've got no marketplace when it's over. Our marketplace has one specialist, but I think that's greatly misunderstood, because we don't really depend on the one specialist for liquidity. Aside from their dealings when there is a temporary imbalance, we depend on the member firm community who comes in and out with risk capital and block trading and other things that as well. But the real markets are really made by the 47 million individual investors and the 13,000 institutions who are the real buyers and sellers in that market. And if you look at the 20th, for instance, after the opening the market had sold off and then kind of reached a calm around noon, and everybody was speculating whether that was the eye of the hurricane or whether the storm was over. The reason the market turned in the next few days is because real buying came back into the market. Okay? Value buyers, both institutions and individuals, came back in the market to do that. So that any dealer system you had under ordinary times is to help to provide liquidity when there is an absence of that. And in extraordinary times, they at least try to cushion it down. And we think one of the reasons that our dealer system did better than the universe, or did better than the universe, is because we had some assigned responsibility to them. And you can argue about, at the margin, whether some did or didn't, and whether some were really exceptional and others weren't. But as a whole, the system under those incredible circumstances did well. And I think that's what the Commission report said as well. And we have to deal with them at the margin. But no one dealer system, or no three dealers, could help you stem the kinds of onslaught and selling that you had before. And the reason we think that our dealer system worked as well as it did under the circumstances because we had assigned responsibility. London was a clear example where they did not, and everybody stood aside to wait till it balanced again. And so that's no criticism of their market. It's just that if you were to look at all markets on the week of the 19th and come to some conclusion, you would have come to a conclusion that multiple dealers had a fatal flaw. All right? I don't agree with that. Okay? All I'm saying is traders are traders the world over, whether they be in stocks, options, futures, currency, debt, or whatever, and that given an avalanche of selling, the human instinct is to get out of the way for a while and then come back in when it stabilizes again. And that basically is what happened all over the world. And if you look at the charts of different markets and different exchanges and different stocks, it's absolutely incredible. They almost all look the same. Domestically, even the futures markets look the same, all right? London, the stocks look the same. Tokyo, they look the same. Germany, they look the same. Madrid, they look the same. Paris, they look the same. It's incredible. And so they all had that same force at the same time. They all basically reacted in the same way. The difference was in the amplitude of the decline. Some went down further than others, and then all moved sideways the same way. It's absolutely extraordinary. I don't know whether it's a comment on the instant liquidity that was sought all over the world by institutions and individuals, whether it has to do with technology and communications, but surely it surely shows that everything is getting tighter and tighter together.
Thank you, gentlemen. Any more questions? Thank you very much, Chairman Phelan. If I had time, I'd ask you how it is that with the New York Stock Exchange, the biggest equity market in the world and very efficient market, superb leadership in your person of view, why it is that the Chicago has been able to run away with the futures in equity. But that's something that maybe we can leave to another date, and I'm sure it would take quite a while to discuss, so I'm not going to ask you that.
Different market, different culture.
Okay, very good. Our final witness is Richard Fogel, Assistant Comptroller General. Mr. Fogel, we're Happy to have you here. Mr. Vogel, all of us have a great deal of admiration and respect for the General Accounting Office, and you have the expertise, you have the objectivity, and we're delighted to have you before us. You have a nice, concise statement, so go right ahead, sir.
Thank you, Mr. Chairman. I'd like to introduce my two colleagues. On my right is Craig Simmons, who's our Senior Associate Director in charge of all our financial institutions work. And on my left is Randy Schultz, who is a Project Director for our work on the market crash. What I'd like to do is just very briefly summarize the highlights of my statement. And the details of our findings were presented in our report of January 26th. The issues, problems, and concerns that we had fall into three broad areas. First, we must protect the rest of the economy from spillover effects of a sudden collapse in share prices. Second, we must assure that the equity and futures markets function efficiently and effectively, and we found problems both within each market and among them. And third, treatment of individual investors must be fair. Now, based on all the work we did, we think two areas deserve immediate attention. First, the automated systems that help the markets function smoothly must be assessed and changed, if necessary, to assure that they can handle the demands of modern markets. And in that regard, we're very pleased with the actions that the New York Stock Exchange says it's taking to try to improve its automated systems. Second, and perhaps more important overall, is that coordinated contingency planning is urgently needed to prepare for any future crisis that may occur. What we found is that the federal regulators and the SROs did a very admirable job during the 19th and 20th, but basically they did it on an ad hoc basis. No intermarket, interagency contingency plans existed to help answer the question, what will happen next? And accordingly, we believe that within the next 30 to 60 days, the federal regulatory agencies, perhaps with Treasury, along with the SROs, need to develop contingency plans that can result in several things. First, agreement on and dissemination of information about how decisions made by both the CFTC and the SEC are made and communicated to the markets. Two, agreements on steps to be taken during crises and those circumstances that would call for relaxation or interpretation of rules to facilitate market liquidity. Third, agreements on Federal Reserve liquidity support mechanisms for market participants. Now, over the long term, we think several other things need to be done. We need to identify any problems which may be created by differing rules and procedures, such as margins, price limits, trading halts, market pricing mechanisms, or trading system shutdowns that affect closely related stocks, stock index futures, and options. And indeed, the capabilities of the specialists and the other market-making systems in the new market environment need to be studied. But in essence, we're saying we would like to see the Congress give all the groups 30, maybe 60 days, but we're very comfortable, and we know you've asked for people to come back in 30 days with proposals. Give them 30 days to come up with some plans. And then, if you're not satisfied with those, then we think perhaps some additional actions need to be looked at.
Thank you, sir. Thank you for a very concise presentation, for a fine written statement. Mr. Fogel, the GAO report refers on page 73, and I'm quoting now, to significant processing problems involving volumes in excess of some systems, unquote. Capacity systems design limitations which were exposed by the heavy volume, and hardware and software failures. That was during October 19th and 20th. In fact, your report states on that page that operating problems occurred on 9 of the exchange's 12 major automated systems on these 2 days. What actions do you think that the New York Stock Exchange should take to remedy these deficiencies, particularly in light of the response we got this morning from Mr. Phelan?
Well, we think the actions that Mr. Phelan outlined this morning are going the right way. One thing we
Are they sufficient?
We don't know at this point in time. And what we think that is important to do is to have some outside group work with the exchange to assess the adequacy of what they propose to do. We believe that's important when you're looking at any type of computer operations, to have someone who's not real close to it come in and take a look at the adequacy of it.
Who would you suggest for that, the GAO?
Well, we'd be glad to take a look at what they propose. But before we get involved, I think we also think it's very important that the SEC have the capability to assess what the New York Exchange proposes. And in that regard, we think they need some more resources and some more expertise to do that. But the GAO could go in and look at it, but we would certainly think that as a first step, the New York Exchange might want to call in an outside group of experts to take a look at what they're proposing.
Do you concur in the confident assertion by Chairman Phelan that they could now handle a 600 million share a day without interruption and without any of the problems that they had on Black Monday?
I'm not sure that we could concur until we took a look a little more in depth at what the specifics of what they proposed are.
During the past few days, this committee has heard that small investors have made a large number of complaints regarding their treatment during the crash. Senator Sasser pursued that line very effectively. It's agreed that the small investor has difficulty in accessing the market on October 19th and 20th. Moreover, your testimony refers, and I quote again, to the possibility that there were abuses of risk disclosure and suitability rules. We've all read horror stories in the press that relate to this issue. Has the GAO conducted an independent analysis of consumer complaints following the stock market crash?
We have not as yet done that, Mr. Chairman. We did compile, and the details are on page 52 of our report, the types of complaints that people said they had. Most of the complaints had to do with the ability to execute orders. We intend to try to follow up more to look into that in depth, but as of this point in time, we haven't conducted an independent assessment. Now, we also got a lot of information regarding something referred to this morning, and I know has been referred to earlier in the week, about the inability of people to get through, and the phones were all clogged up. That has to do with execution, and we're aware that NASDAQ has tried to take some actions to improve that.
Do you have any proposals that would better protect the general public's interest in the future and the general investor's interest?
Not specifically at this point in time. We are very concerned about any changes that are made that they take into account the need to ensure fair and equitable treatment for all people in the markets. I think we're pleased that NASDAQ has proposed those things. I think that based on what we've heard from talking to people, we're concerned about adequate enforcement of the suitability rules, for example. We're concerned about making sure that in the futures market, people really understand, the paperwork that's given to them that explains the risk. Now, I don't know that you need different regulation. There may be a question of how efficiently and effectively we enforce the regulation already on the books.
The GAO report, in common with several other studies of the market crash, all testify to the fact that financial markets are integrated both within and outside the United States. They talk about one market, one global market. In your testimony, you recommend that ways should be, and I quote, be sought to harmonize regulation across national boundaries, unquote. Do you have any specific proposals that would achieve that objective?
I'd like to let Mr. Simmons answer that in a little more detail. I think going along with what Senator Worth said this morning, we see that there has to be some phasing, so that once you...
Has to be some what?
Some phasing of trying to deal with the problems. So once you deal with our problems in this country, we think we've got to look at what's going on in London and Tokyo. It becomes more difficult then because you've got to decide who's going to be dealing with those people overseas.
I really don't have much to add to that. It seems to me that the proposal by the Governor of the Bank of England the other day might be a good start. He has proposed getting the securities regulators together to just begin discussing how they might work out these intermarket problems that they have.
Senator Worth?
Thank you, Mr. Chairman and gentlemen. Thank you very much for the usual excellent work done by the GAO and your professionalism. Just to pick up on that last comment for a minute on the Bank of England proposal and the Kaufman proposal, it does, and Henry Kaufman, as you know, has a proposal that we ought to create a kind of international oversight group as well. It does impress me that it's a bit difficult for us in the United States to think about that when we're so balkanized here with absolutely no voice that, you know, who would we send to sit at the table? We'd probably have a squabble between the SEC, the CFTC, the Fed, and the Treasury as to who is going to be the lead person sitting at the head of the table on behalf of the United States. A bit difficult to think that we could do that. Isn't that correct? I mean,
I think that is a problem, yes.
We've got to do our own homework here.
I think the central banks in the other countries typically do have the securities part of their regulatory structure embedded within the bank, and we're organized differently in this
So
country.
the coordination problem comes back to us from the international side as well.
Yes,
we have to sort out our own backyard first and foremost, which again is, you know, one of the chores I think that we face. Let me just quote from your report and ask you to expand on this a little bit. You say the events of October clearly established the need for some continuing coordinated intermarket regulation to implement emergency plans, make decisions about some issues such as margins, trading limits, or other suggestions being made to address intermarket linkages, and reconcile these issues with other national and international factors. You go on to say that, however, you put this caveat in, these industries are primarily self-regulated, with differing levels and types of federal roles, all previously debated by the Congress. If any attempt is made to consolidate the agencies, these roles and relationships would have to be carefully thought out. Is that an extensive process? How do we go about doing that? You all are observers of the Congress as well as of this problem, and what we're trying to do is to figure out how to get to neutralize a lot of the veto power that's out there for doing anything and get that into a process of analysis so we can start to create some sort of agreement as to what this harmonization or rationalization of the regulatory process ought to be.
Well, it seems to me that one of the things you have to ask when you begin to look at that is what's broke and what problems are we trying to correct. There's a lot of activities, for example, that the CFTC and the SEC are involved in, day-to-day activities of regulating their markets that they do pretty well and really don't cross each other's paths. Yeah. So one of the things you know, we've debated among ourselves on this is, well, do you really need to bring all that together? That sort of functions fairly smoothly. It's on these linkages where the markets are linked that it becomes more difficult. And we're not quite sure at this point in time that you need a permanent change in the regulatory structure to deal with these intermarket linkages. And that's one of the key issues. Obviously, when we talk about contingency planning, and it gets into some of the longer range issues too, there has to be a plan for better coordination and communication. There has to be much better process for deciding, for example, when the markets are going to stay open and stay closed, because that was a critical issue on Tuesday. We don't have that right now. So what we think you've got to do is detail those specific things, and then you've got to decide what type of structure you want to address those problems.
Well, I find myself in great agreement with what you're saying. It seems to me that is similar to what other witnesses have said in this last week, that a lot of the internal workings of these markets are well regulated and self-regulated, and they don't have much to do with the other markets. What we're trying to look at is not only the areas of overlap and the areas of gap, but where should we as a national economy try to coordinate this so that we can speak more clearly in an international sense. We're looking for gaps, we're looking for overlap, and we're looking for some kind of the ability to create an international voice. Now, we have a couple of choices facing us here. We have three, I guess. One is to do nothing. A second is to assume that we have enough knowledge to move into this right now and make the decision as to what this mechanism would be. And a third is to, I think, reflect upon what you all said in your conclusions, that we have to learn a lot more about this. So therefore, you know, I would conclude, and I guess this is what you conclude, that we got to set up some kind of a phased mechanism in here to get the various parties together look at this very carefully. It's a very delicate mechanism. We can make a significant error in this. We got to set up the process right away in the Congress. We got to set up that process now to start the movement toward the examination and discovery of the gaps, the overlap, and our international voice. Is that?
Yes, I'd agree with that, Senator. I think we think there has to be some sense of urgency that the Congress exhibits in terms of trying to get, for example, the federal regulators and the SROs together to do this, though. And I don't think we'd feel.
We got to make them do it, I think.
That's right. I don't think we'd feel very comfortable if they took 6 months, a year, 2 years to study this thing and didn't come to any resolution.
Oh, I think that's right. I mean, I think we have to require them to do it, and that's right. Maybe as far as we ought to go legislatively right now, is to lay out that charter, tell them to do it, and to do it by a certain time and get back to us. To go beyond that at this point is a little presumptuous of us, given the not only all the political disagreement is out there and the thicket we're going to get into, but the fact that we don't know enough to make that decision now.
I think that's a position we'd agree with, yes.
Thank you very much, Mr. Chairman.
Senator Graham.
Mr. Chairman, I'd like to pursue the line of questions that Senator Worth has been leading. To what extent do you feel that the current relatively low level of cooperation among international securities markets? I think yesterday we had some very strong testimony at the almost confrontational quality of that relationship in the futures market is a function of the internal diffusion and decentralization of decision-making within the United States structure.
I don't think we have much of an opinion on the international problems. I think that in terms of where we are in the United States today vis-a-vis New York and Chicago, I think we're somewhat encouraged in the last week, and being somewhat cynical, I'm impressed that maybe all these groups have come forward the day before they've testified before you to come up with proposals. But I think that's the way it's got to go, that there has to be a confluence of opinion among our own markets as to what's good for everyone, and not just looking at their own particular situation, but as to how that relates to the international situation. We just haven't looked at that. And
I guess the question, and maybe if you have not looked at it, maybe you might do so based on your recent experience analyzing our domestic issues, is what have been the constraints or the absence of incentives which to date have led to a relatively modest extent of international discussion, cooperation, agreement in the securities market, in contrast to the extensive relationships which exist in the banking sector?
Well, one opinion I'd have is that perhaps it takes something like the events of last October for us all to realize how linked everything is. You know, there's been discussion that the markets are linked. There's certainly, we observed this a couple of years ago, and other people have earlier than this, talking about the linkage between the equities markets and the futures markets, but it becomes much more vivid when you have a crisis, and perhaps there has not been as much of a realization in the international community of how linked things are as there obviously has been in the banking area.
I think we also have to recognize, Senator, that the growth of international equity markets, of course, compared to international banking, has been relevant, and competitive factors too. It is not as well developed, however, as it is on the banking side, and certainly the events of the 19th and 20th should give impetus toward all of those regulators getting together. There have been, as you're probably aware, rounds of meetings of several of the nations taking place, even within the last couple of weeks. So if nothing else, the 19th and 20th gives impetus to that kind of thing.
Senator Florida would just yield for an observation. The most overwhelming development in finance has been the internationalization of finance and the huge increase in flows between countries, Japan and the United States, the United Kingdom, just enormous. And it's come on with a great, great rush, doubling, tripling every year. I think this is something we're not up to speed on.
Mr. Chairman, I'd like my remaining time to shift to another topic. In your statement on the page 1, under the category Issues, Problems, and Concerns, the first one concludes with this sentence: the Federal Reserve met its responsibilities effectively during the crisis, but may face difficulties in the future if care is not taken in any relaxation of Glass-Steagall restrictions. That's an issue of considerable interest to this committee. Could you elaborate on what you see as those potential future difficulties?
Well, I don't know that we see them as difficulties, but I think the concerns we have are that if you relax Glass-Steagall, what we're concerned about is liquidity and the safety and soundness of the banking system. And our concern is that if you have the banking area getting into the securities business, we think that the Fed has to become more involved from both a supervision and an auditing perspective to make sure that whatever rules and regulations are put in place are in fact followed by the industry. So that's what we're saying there, that if there is a relaxation and the banks get more involved, the Fed has to be fairly aggressive in auditing and in supervising how the rules and regulations.
Federal Reserve attention prior to relaxation of Glass-Steagall should be?
We'd be pleased to do that.
On that subject, the Fed supports, of course, the participation of banks in securities selling, and the repeal of Glass-Steagall is proposed by the committee. And of course, the Fed has the competence, and also they're not known as a reckless or irresponsible agency. Thank you. Unless there are further questions, thank you very, very much.
If I might just
I beg your pardon.
If I might just going back to this process of the process of setting up a coordinating mechanism. I'm not quite sure how else to define it, or the phased harmonization. You all have just spent 4 months looking at this issue. I mean, you're as up to speed, I suppose, as just about anybody in that we work with in the government. Would it be possible for you all to work with the committee or work with our staffs in trying to figure out how we might, craft the language for the charter that you're talking about? Is GAO allowed to do that sort of thing? Can we ask you to do that? What would that charter look like?
Yes, we'd be pleased to do that. And one idea we've talked about, and it's very tentative, is that, for example, after let's say 30 days, if the committee isn't satisfied with the progress, and to answer that question, you've got to have someone go in, and we'd be glad to help you do this and assess what's going on. And then everyone has to report back to you, and then you'd have to make some assessment. Are you satisfied or not with the progress? And if you aren't, then we think you'd have to explore some possible alternative, maybe short-term or arrangements to facilitate these people coming together. We'd be glad to work with you on that.
I think there are two parts to the issue. One is the structure, and second is kind of a time frame that you're just talking about, that you do it with the right charter and then set up the kind of milestones so that you can enforce the sense of urgency that I think Senator Graham and I share with you about the need to do this. We look forward to that. Thank you very much. Thank you, Mr. Chairman.
Thank you. Before you leave, I just would like to announce that this concludes our hearings, and we expect to have reports from the regulators by March 4th on their recommendations for legislation. We then expect to draft the legislation and hold hearings on the legislation. Thank you very much. Meeting stands adjourned.